The gold test, how the yield illusion fuels the global rush to de-dollarize. Section 1, Introduction. For decades, U.S. Treasury bonds have been regarded as the ultimate safe asset, the backbone of global reserves, pension funds, and individual retirement portfolios. With their promise of steady yield and full repayment, they became the cornerstone of what many considered responsible financial stewardship. But what if that promise was never real? What if the yield, so proudly offered by the U.S. government, was merely a surface illusion, a nominal return designed to hide a deeper erosion of value beneath the waves of inflation? This exposition begins with a simple question. Would a long-term saver have been better off simply buying and holding gold? To find out, we ran a 25-year comparative experiment. One person saved $10,000 a year in gold. Another put the same amount annually into 10-year U.S. Treasuries, rolling them forward. A third simply stored their cash under a mattress. The results are not only revealing, they may help explain why nations around the world are slowly but deliberately reducing their reliance on the U.S. dollar. The gold test isn't just a financial experiment. It may be the key to understanding the structural momentum behind global de-dollarization. Section 2, the experiment design. To evaluate the real-world outcomes of saving in gold, treasuries, or cash, we constructed a 25-year simulation, spanning from the year 2000 through to August 2025. The goal was to examine which saving method best preserved real purchasing power, not just nominal returns. The parameters: annual contribution, $10,000 per year, fixed in nominal U.S. dollars, reflecting realistic saving behavior. Time horizon, 25 years, from 2000 to 2025. Inflation adjustment. U.S. Consumer Price Index data was used to calculate the real inflation-adjusted value of each strategy at the end of the period. Taxes and fees, ignored for simplicity and comparability across methods. Reinvestment. Treasury interest was reinvested annually. No reinvestment needed for gold or cash. Gold, Person A. Each year, Person A uses their $10,000 to buy physical gold at that year's average market price. The gold is securely held with no yield, but no fees or storage costs are factored in. At the end of 2025, the total ounces are valued at the prevailing gold price, approximately $3,371 per ounce. Treasuries, Person B. Person B buys 10-year U.S. Treasury bonds each year at the average yield for that year. For simplicity, each contribution is modeled as a fixed income investment earning that year's yield, compounded annually until 2025. After maturity, proceeds are reinvested. Cash under the mattress. Person C simply stores $10,000 in physical U.S. dollars each year, making no investment. This serves as a control, revealing the erosion of purchasing power when savings are held in fiat form without yield. The central metric, real value. All final savings totals are adjusted to $2025 using official CPI data. This allows a direct comparison of how much actual purchasing power each method preserves. The stage is set. Now we'll examine what these savers ended up with and what their outcomes reveal about the illusion baked into the global yield machine. Section 3, the yield illusion. The word yield evokes confidence. It suggests growth, income, security. For much of modern financial history, U.S. Treasury bonds, backed by the full faith and credit of the U.S. government, embodied this confidence. They offered a predictable stream of returns with near zero default risk. Global institutions, central banks, and retirement systems treated them as sacrosanct. But what happens when yield is merely a mirage? Nominal yield versus real return. From 2000 to 2025, the 10-year Treasury yield steadily declined from around 6% to below 1% before partially recovering to the 4 to 5% range. While investors technically earned interest, what they gained in nominal dollars, they often lost in purchasing power. Why? Because inflation quietly hollowed out the value of those dollars. The Consumer Price Index rose from 172.2 in 2000 to 323.05 by mid-2025, an 88% increase. That means a dollar in 2000 is now worth just over 50 cents in purchasing power. A bond that yields 3% in a 3% inflation environment produces a real return of zero. But few investors account for this unless inflation is front-page news. Yield becomes a sedative. It dulls concern while your real wealth erodes slowly in the background. Reinvestment as an illusion of growth. Even with reinvested interest, the purchasing power of Treasury holdings eroded over time. In our simulation, $10,000 contributed annually over 25 years to Treasuries, compounded to over $570,000 nominally. But adjusted for inflation, that sum shrank to just over $300,000 in year 2000 terms. This is the essence of the yield illusion, a number that grows on paper but stands still or retreats in the real world. A system built on perception. This illusion isn't a bug, it's a feature. The global financial system depends on the widespread belief that U.S. Treasuries are the safest way to store value. That belief feeds demand, keeps bond prices high, and supports U.S. fiscal expansion. But once that belief weakens, once the illusion is measured against a harder truth, the entire system begins to look more fragile than safe. And that's where gold enters the picture. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Section 4. Results of the gold test. This section delivers the verdict. After 25 years of steady saving, who actually preserved more real wealth? The yield seeker, the gold hoarder, or the fiat stasher? Let's break it down. Gold, person A, the silent compounder. Total ounces accumulated from 2000 to 2025, approximately 310 ounces. Gold price in August 2025, approximately $3,371 per ounce. Nominal value, approximately $1,045,038. Inflation-adjusted value in year $2,000, approximately $557,060. Despite earning no yield, gold delivered the highest real return of the three strategies. The compounding happened not through interest, but through repricing, as fiat debasement pushed the price of gold higher in dollar terms. Gold absorbed the monetary expansion. It was never productive in the conventional sense, yet it preserved purchasing power more effectively than the world's most trusted debt instrument. Treasuries, person B, the eroding yield machine. Nominal account value, approximately $570,000. Inflation-adjusted value, approximately $303,837. Though Treasuries delivered steady nominal returns, inflation quietly consumed them. For long periods, especially after 2008, real yields were zero or negative. The saver appeared to be winning until they checked what their money could actually buy. And even after a partial yield recovery post-2022, it wasn't enough to reverse the lost ground from the zero interest rate policy years. Cash. Person C, the flatline strategy. Nominal amount saved, $250,000. Inflation-adjusted value, approximately $187,500. This was the purest exposure to dollar debasement and the most devastating. No yield. No asset appreciation. Just a slow, steady bleed. By 2025, $250,000 stored in cash lost nearly 50% of its real purchasing power relative to the year 2000. If Treasuries were an illusion, fiat cash was a guaranteed loss. Comparative table: inflation adjusted in year 2000 dollar strategy, gold nominal value $1,045,038, real value $557,060. Treasuries, nominal value $570,000, real value $303,837. Cash nominal value $250,000, real value $187,500. Key insight: gold outperformed despite offering zero yield. Treasuries underperformed despite offering consistent yield. Cash evaporated despite appearing safe. The experiment validated our original suspicion. Yield alone is not a reliable measure of wealth preservation. It can obscure deeper losses in purchasing power, especially when the currency itself is melting. Section 5. The global consequences. The implications of the gold test stretch far beyond personal finance. This isn't just a story about three savers. It's a metaphor for how entire nations manage their reserves, store their wealth, and decide who to trust with their financial future. and the results expose a contradiction at the heart of the modern monetary system. The very instruments that the world uses to safely save wealth, U.S. Treasuries, are systematically eroding that wealth in real terms. Why Treasuries became the global default. Countries like China, Japan, and oil exporting nations parked their surpluses in treasuries because they were liquid and stable. The US dollar was the global unit of account. Yield, even modest, was better than zero. Holding treasuries meant staying plugged into the global dollar order. But that belief rested on an assumption that the yield would always beat inflation. When that assumption fails, the rationale begins to unravel. Central banks are quietly reacting. China has been reducing its treasury holdings and increasing its gold reserves. Russia replaced most of its U.S. debt exposure with gold and yuan. India, Turkey, and Brazil are all accumulating gold. Even European institutions are reconsidering their U.S. exposure. Not out of ideology, but math. The gold test, scaled to sovereign balance sheets, shows why. Why de-dollarization is rational, not radical. Reserves held in treasuries with negative real yields are losing wealth every year. More debt issuance means more supply and weaker real value. With political limits on rate hikes, real yields may stay negative for decades. In this light, moving into gold or neutral assets becomes defense, not defiance. The structural problem. If treasuries no longer preserve value, the global foundation is cracked. This won't trigger collapse overnight, but it does mean weaker demand for U.S. debt, higher rates to attract buyers, more trade in non-dollar terms, and continued central bank rotation from bonds to bullion. Section 6. Implications for the future. If the gold test exposes a flaw in how the world stores value, what happens next? 1. The end of risk-free as we know it. The risk-free return of treasuries no longer guarantees real wealth preservation. If gold preserves value better, the global definition of safe asset must change. 2. Gold repositioned. Gold is returning as a core reserve asset, not just a hedge, used for trade settlement, currency backing, and reserve diversification. 3. Bitcoin enters the conversation. With fixed supply, global settlement, and provable scarcity, Bitcoin may become the digital counterpart to gold, with portability and programmability added. 4. A new reserve regime. The future may include gold, digital currencies, commodities, selective bonds. The world shifts from scale and muscle to neutrality and scarcity. 5. U.S. policy challenges ahead. Declining demand for treasuries forces a choice: raise rates and risk instability, or print more and deepen debasement. The illusion may persist until it can no longer fund itself. The gold test is not just a financial experiment, it is a stress test for the global order. Section 7. Conclusion. The gold test began with a simple question: which store of value best preserves purchasing power over time, gold, treasuries, or fiat cash? The results evolved into something larger. What if the world's most trusted financial asset is failing its most basic function? The verdict: gold won through repricing. Treasuries delivered real losses. Cash melted in plain sight. What the gold test reveals. The yield illusion is not an accident, it is a design. Saving in nominal terms does not equal wealth preservation. Nations are waking up to this and acting accordingly. A catalyst for de-dollarization. The shift away from treasuries is not rebellion, it is rationality. Gold, once dismissed, has proven its staying power. You cannot build a monetary future on promises that melt, but you can anchor it to something that holds. Final insight: what you save in matters more than what it earns. In an age of engineered inflation and manipulated rates, yield is no longer the measure of financial intelligence. Purchasing power is. And when the illusions fade, what's left standing is what was real all along.